Hi, this is Bill Cantor, and I'm an attorney and estate planner and financial planner in Skokie, Illinois, and the owner of Complete Estate and Retirement Planning. I'm also the owner of the websites www.therothconversionexpert.com and www.rothconversionyesorno.com. In today's video segment on Roth IRAs, I wanted to discuss the special rules regarding Roth IRA conversions in 2010. There's really two rules. One of them is very simple and very potent, and the other one requires a little bit of explanation and may not be such a big a deal. The very important rule is that in 2010 anybody can convert to a Roth IRA. Before 2010, if you made more than $100,000, you could not convert to a Roth. Those income limits have gone away, so anybody can convert to a Roth IRA. The other rule requires a little bit of explanation. It's called the deferral rule, and it allows you to pay the taxes that the Roth IRA conversion costs over 2 years. But I want to explain how that works. So first of all, in a normal year, let's say 2009 or 2011, let's say it's 2009, if you convert to a Roth IRA, you pick up all of the amount you converted as income in that year. So let's say it's February 2009, and you want to convert $100,000 to a Roth IRA. And we have other videos talking about the benefits of converting, but basically all the money that comes out of the IRA, whether it's now or the next generation, is not taxable. You also don't have to take required minimum distributions from a Roth IRA. So you can leave all the money in your IRA, let it all grow tax-free, and it will come out tax-free as well. Anyway, let's say it's February 2009, and you convert $100,000 to a Roth IRA. Well, in 2009, you're going to pick all that up as income, which means in April of 2010, when you file your 2009 return, you will have all that as income, that you'll pick up that $100,000. And if you're in a, let's say, 28% tax bracket, you'll have an extra $28,000 of taxes to pay. Well, the rule in 2010 is that if you convert in 2010, let's say the same February 2010, you convert $100,000, you can either report all the income in 2010 and pay it April 2011 when you file your 2010 return, or you can choose not to report any income in 2010, but rather report half the income in 2011 and pay the tax on that April 2012 when you fill out your 2011 return, and the other half you report in 2012 and you'll pay that in April of 2013 when you file your 2012 return. So you can convert in, let's say, February of 2010 and not make the final payment on that conversion until April of 2013. And initially that seems like a great thing. You know, deferral of taxes is always a good thing. But the question is it really? And it may not be such a great idea. I tell my clients that you should only take advantage of the deferral if you have to, and I'll explain what I mean in a minute. But why isn't that such a great thing? Well, it's not because, or may not be for you, because tax rates are going to go up. Even if Congress doesn't raise tax rates, which many believe that they will and soon, tax rates are still going to go up at the end of 2010. They're already set to go up. Right now the top or marginal tax rates are 25%, 28%, 33%, and 35%. Those are going to go up. The 25 is going to become 28, the 28 is going to become 31, the 33% is going to become 36%, and the 35% rate is going to become 39.6. So if you defer your taxes, you are deferring into higher rates. So let's say you have $100,000 you were converting in 2010 and you're in a 28% tax bracket, that conversion will cost you $28,000 and you'll pay that next April 15th or April when you file your return. But if you defer, let's say $100,000, you're going to be in a 31% tax bracket in 2011 and 12, if not more. And that way, it will cost you an extra $3,000. That conversion will cost you $31,000, not $28,000. So deferral really only makes sense if you need to, meaning if you have funds outside the IRA to pay the conversion tax, which is how you should most of the time make the conversion, but you don't have enough, and you want to report it in 2000. You won't have enough till 2012 and 2013. So reporting the taxes half and half in 2011 and 2012 helps you make the conversion because you don't have the cash flow to pay it all in April of 2011 for 2010's return. So you want to extend the payments. So it may cost you more but it's the only way you could do it because you want to pay a Roth conversion tax out of non-IRA funds. You want to leave all the money in the IRA to make as much as you can and pay the conversion tax from non-IRA funds. So that's just how you should treat the deferral option. Whether Roth conversion is right for you is, of course, something you have to analyze. If you want to call my office, my number is 847-674-6470. Or again, go to our websites, www.therothconversionexpert.com and www.rothconversionyesorno.com.